One of the disappointments with IPOs this year has been the poor aftermarket performance. IPOs on average lost money, as you have noted, after the first day of trading. Now, why was that happening, and is there any improvement recently?
Well, there's definitely been an improvement recently. The aftermarket returns are positive now for the last 3 months. I think it's about 12%, which is very good. But if you drag along the full year, they're just about break even now. When aftermarket returns go negative, investors start to step back, and you don't get the follow through that you want with a priced IPO. So that signals a slowdown in interest, and then is therefore a slowdown in the IPO market. We saw that in terms of issuance. We saw that slowdown this past summer. We also had a slowdown related to the Chinese IPOs that were done. Those performed very poorly, so that dragged down the aftermarket returns too.
Yeah.
And we go through a cycle. Now we're at a better phase of the cycle. Valuations seem to be pricey, especially for the tech companies. So then you see the new ones come in, they're priced better, the aftermarket returns improve, and the cycle kind of starts over again.
So it strikes me as two things happen. When I saw the IPO ETF drop notably, it was February, March. That's when interest rates also moved up, and obviously higher rates affect some of these younger startup growth companies, which are valued less on a discounted cash flow model. I think that's probably a major issue, but also prices were too high. Are you saying that we've seen the IPO ETF do better in the last month or so? Is this because in July and August the IPOs, the price were lower priced and they're performing better in the aftermarket after they start trading?
I think that it's a little bit of that because the ETF is including companies that are already public and just on a quarterly basis will pick up new ones. So I think it had to do with the performance of growth companies, as you mentioned, when interest rates appeared to be rising. It's not happening now. But if rates go up, it does affect the value of growth companies. Now we seem to have turned around, and we're in a market where investors just want growth. They're ignoring anything that's not growing. So investors are willing to pay a lot of money for growth when interest rates the real return is negative on any kind of fixed income product. So in terms of yield, you really value then a company that can produce growth and cash flow. And interestingly enough, unlike 2000, the cash flow is very good on most of these companies.
Yeah.